Hello everybody and welcome back to another weird and wonderful week on Wall Street. Today we're going to give you a little midweek check-in to take you through some of the highs and lows of what's been going on in the market so far. So first of all, we're going to head over to our lovely weekly heat map over here, where you can see that everything is in the green. And trust me, it's been a while since I've said that. But US stocks seem to have gotten off to a fairly strong start to the week. Most of the major indices are up, and everything is looking pretty good for right now. However, if we take this down to a monthly heat map, today is the last month of June after all, you can see things are not looking nearly as luscious, and even worse if we take that down to a 3-month heat map. There's a lot of deep red going on here. The reason for that is because amid what I think you could only call market mayhem, companies are finding it really hard to grow, which brings us very nicely to our first story of the day, which is growth stocks. So every year, the FTSE Russell re-weights all of its indexes, shuffles everything around, and what everybody's talking about this year is the fact that Meta, Netflix, PayPal, and Zoom have all been moved from the Russell's growth index to its value index. What does that mean, you ask? Well, neither is better or worse than the other. It's just a different strategy for investing and depends completely on the preferences of the trader. But we do have a little explanation here for you. If I were to put it in the simplest terms possible, growth stocks are those that are seen as having the potential to outperform the market in the future based on potentially impressive earnings and revenue, often based on their business model or something like that, whereas value stocks are those that are seen as currently underperforming the market, and the idea is that if you get in now, you'll be able to realize those gains when the market catches up with you. So, on what's happened to these companies, you ask, because all 4 of these were considered pandemic darlings. They were surging throughout COVID. This year, things have taken a little bit of a turn for the worse. Meta is down 50%. PayPal has lost 60%, Netflix is down 68%, and Zoom is down 35%. What has happened to these giants of growth who, back in the day, you could almost say were leading the growth industry? Well, inflation, rate hikes, the economy, the same thing that's happened to everybody else. Inflation and rate hikes have made it really difficult for these companies to finance the growth that they've promised everyone. And on the investor side of things, people are much less keen to put their money in the potential of growth than they are to put their money somewhere where they actually see value right now, especially as everybody tightens up those purse strings. On the plus side, it does mean that there are some value funds or ETFs that could pick up these stocks and add them to their portfolios, which could give them access to a whole new crew of investors. Do you know who loves a value stock? Warren Buffett, that's who. Yep, him and Berkshire Hathaway have been very busy this year buying up equities. Their equity spending in Q1 totaled at $41 billion, which is almost as much as Elon offered to buy for Twitter. Still no word on that, by the way. And this week, Berkshire announced that they have spent another $44 million on Oxy stock, taking their stake up to 16.8%. Oxy is now Berkshire's 7th largest position, and they have just over $8.8 billion invested in the company. Regarding last week's decision of stacking up a little bit, there's probably some buy-the-dip mentality going on there from Buffett. If you take a look at light crude oil futures, they had a bit of a tumble in the last 2 weeks, and so he could have been making the most of that. However, this week, things have gone back into the green after 2 key OPEC members, Saudi Arabia and the UAE, both flagged a whole bunch of production and capacity issues. They said that they are already behind on their schedules. They're unlikely to be able to significantly boost output, and that they are in their worst position in recent years, which obviously is not great for oil and gas prices, which are already skyrocketing, as I'm sure you know. It's also been pointed out by an analyst that it is not entirely impossible that Russia cut off all oil and gas supplies to Europe, all of their pipelines. Again, that would be pretty devastating for the price of these commodities. There's already a crisis going on. It could be why G7 leaders are meeting to potentially decide on capping the price of oil and gas. They don't want Russia to be able to profit off of their domination of this commodity, so they're going to see if they can get in the way of that. Russia brings us nicely to our third story of the day, which is Russia and its historic default. So Russia has officially been declared in default for the first time since 1918 after missing one of its key deadlines. So obviously in 1998 it did default on about $40 billion worth of local debt, but this is the first time in over a century that it's defaulted to its foreign creditors. It's kind of a big deal. Obviously, Russia has said that it's a farce. The country does, in fact, have the cash, but they've been unable to actually pay those creditors because of all of the sanctions that have been placed against them by the West amid their invasion of Ukraine. It's unlikely that either party are going to roll over anytime soon. Things have been going on for a while now. However, the G7 and Biden are meeting in July, so we might get another update on that front. July is also when we're going to get our next cycle of rate hikes, which are said to probably be coming in at a 3/4 point hike once again. So make sure you're paying attention in July, because the news is probably going to be popping off and it's probably going to be reflected in your portfolio. Until then, don't forget that we can keep you up to date on all of the market news in your inbox or on our lovely Snaps page over here. Just go over and hit subscribe, and we will talk to you soon.